Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Jim Pearce on the line, Chief Investment Officer of Baton Investing. Jim, how you doing on this Thursday morning?
I'm doing great. How are you?
Good, good. Thanks for joining us here before the open. Real quickly, could you give our listeners a little bit of your education and market background?
Sure. I've got a pretty traditional background as far as stockbrokers go. I've got a BA in business from College of William and Mary, and I actually started out as a stockbroker in 1983, only 1 year after I graduated from college. So I've actually been doing this for a little over 30 years. And about 15 years ago, I went through the CFP program, so I have that background as well. But I'm basically a stock guy, at heart, and no longer a stockbroker, but working with Phil Ash and his brother Brad at Baton Investing to provide stock market advice, but in a different manner than as a broker.
So, what lessons did you learn early on in your career as a stockbroker that still hold true today?
I would say the single most important one, and it's just as true now as it was then, is that the vast majority of investors are not capable of objectively assessing their true risk tolerance. It doesn't matter, male, female, young, old, regardless. Almost no one has as much tolerance for losses as they say they do when the market's going up. When it turns around and starts going down, just about everybody discovers they have less risk tolerance than they thought.
Yeah, that's true. Whether you're short-term, medium-term, or long-term investor, that's a great point. So you've managed funds for major banks and brokerage firms and IRAs. Is there any variance in your strategies, or pretty much the same going across the board?
There is a big difference, and in fact, in some cases, the difference is quite pronounced. With banks, the bank itself essentially dictates that their financial advisors take a very risk-averse approach to investing because they view their customers primarily as savers. I mean, if you think about it, a person goes to a bank, they get an FDIC-insured savings account, they might get a low rate of interest, but they know they'll never lose any principal. So when they meet with a financial advisor within that bank environment, even though that's not stated, and in fact, just the opposite is stated in terms of the potential for risk. Nevertheless, there's just this general feeling that they don't expect to lose money. So as a result, banks really encourage their financial advisors to stick with just really low-risk, kind of plain vanilla investments. Brokers, on the other hand, they're competing in the high net worth market where they feel like they've got to show bigger gains. So it's a much more risk-tolerant approach to working with clients' money. IRAs, on the other hand, they tend to be kind of risk agnostic. They view risk and return as all part of the same spectrum. They're not influenced by a parent company that's either a bank or a broker. Most RIAs, generally speaking, tend to be independent or at least operate independent from whomever their parent company is. So there's really no bias one way or the other, I would say, in the RIA market.
Interesting. All right, so you've been analyzing the markets for quite some time. Do you favor fundamental versus technical analysis, or do you try and balance the two?
Well, it's not so much a matter of balancing the two. In the long run, I think fundamentals far outweigh technicals. But in the short run, you have to recognize the power of technicals. So the system that I use to identify stocks is based solely on fundamentals, but when it comes time to make a buy or a sell decision, I do look at the technicals to see if we're, approaching a support or resistance level that's going to influence the market in the short terms. But I don't believe in letting the tail wag the dog, and by that I mean I wouldn't buy a stock just because the technicals were strong if I didn't like the fundamentals.
That makes sense. So when you talk about, technical analysis techniques, your strategies, do you get real fancy with, moving averages, RSIs, MACD, or you just do you pretty much just do the glance over at the chart, eyeball it, find some levels? What's your favorite technical analyst strategies?
Right. No, that's a good question. And I've looked at all those things, and quite frankly, I've reached a point to where for the way I use technicals, I find the Bollinger Bands to be most helpful in finding entry and exit points. I found they tend to be very accurate predictors of the short-term direction of a stock and identifying support and resistance levels. And those, of course, include momentum and things like that. So rather than look at a lot of different factors, I pretty much just go with the Bollinger Bands in terms of figuring out when I want to get in or out of a stock.
Okay, and I mean, we already kind of alluded to this in the first question as far as, lessons that you learned, but just, coming across, new investors. And let's do, we got a lot of, younger people that work here at Benzinga, and I think we got a lot of younger people that listen to the show in the chat room. What do you think's the most common mistake new investors make?
I think by far and away the biggest mistake is what is sometimes referred to as rear view mirror investing, where people look at the 1 year or 2 year track record of a lot of different funds or stocks and pick the ones that have the best returns under the belief that, that recent past performance can be extrapolated into the future. Actually, generally speaking, just the opposite tends to be the case. There's a great chart, I think it's Lipper puts it out, where they break down all the different sectors and they show each year kind of how each ranks in terms of performance. And there's a very clear cyclical pattern to just about every sector. So you'd almost be better off doing just the opposite of what your gut instinct wants you to do, because generally speaking, after any sector has outperformed for a year or two, it's due for some reversion to the mean, and meanwhile, the ones that have been underperforming tend to be ready to also revert to the mean and outperform those other sectors. So that instinct to want to go with whatever's showing the best returns over the last 12 months or so is probably the biggest mistake I see new investors make.
And also along the lines of, longer term investing, you talk to a lot of advisors or brokers and, pretty much, the market's going to go up forever. And in 15, 20 years, the Dow's going to be at 30,000. Are you one of those believers that the market will just move higher over the course of time no matter what and just need the dollar cost average, and that's just the rule of thumb? I mean, it's worked out in the markets at this point. Is that your philosophy as well?
Essentially, yes. And it's not so much no matter what. It's that the market is not a zero-sum game. There's this instinct to think, well, gee, if the market's doubled in value over the last 5 years, then it's way overvalued and therefore must, suffer a huge correction. Asia gets their economies back on track. So it's really important now that you do have some kind of methodology for identifying those stocks that'll end up being the winners.
Do you short stocks?
We don't at Baton. There's another publication I'm involved with called Smart Tech Investor, where last year we shorted several stocks, and actually those worked out quite well. I have a model that I use there where we assign a numerical rating to every stock that we cover, and we did issue some short sell recommendations for the ones that rated the lowest, and some of those were some of our biggest gainers last year, to be honest. But shorting stock in this market, you really need to know what you're doing. So if you've got a lot of new investors listening to this conversation, I wouldn't recommend shorting stocks for them. They may want to buy puts, which is an unleveraged way of betting that a stock or an index is going to go down. As you know, there's, in theory, no limit to the financial exposure on a short sale. But if you buy a put, your only risk is the amount of money you spend on that put. But I do think there's going to be money to be made on the short side of the market in the next 12 to 18 months. So if people have a methodology for doing that, I think there's just as much money to be made there over the next year than there will be on the upside.
Could you talk about any of your, without going into real deep detail, any of your criteria that you use for trying to identify overvalued stocks or sectors?
So every stock is rated on a scale of 0 to 10, and the zeros being the most overvalued and the 10s being the most undervalued. So, and so far at least, the ones rated a 0 and a 1 have been much more accurate in predicting stocks that are about to drop. So I then can also rate each sector by the average score of all the stocks in that sector. So right now, for example, the most overvalued sector, which will come as no surprise to most people, is healthcare, which has just been on a tear. But again, going back to my point about rear view mirror investing, You might look at the 12-month track record of biotech and some of the pharmaceuticals and think, this is the time to jump in. But I would really caution you to be careful with a sector like that, at least according to my model, is overvalued. Conversely, it's emotionally more difficult to buy into sectors that are posting a fairly poor 12 or 18-month track record. But again, those usually tend to be the ones that are most undervalued and ready to bounce back. So, but right now, healthcare is the most overvalued sector, according to my analysis.
All right, and before we let you go, we're on the line with Jim Pearce here, Chief Investment Officer at Baton Investing. Just short-term outlook here for the market, maybe over the next few months so we get over that supposed interest rate hike, and then a little bit longer-term outlook for the market.
Right. So, as I alluded to earlier, even though I believe in the long run the market always goes up, we've been on this, prior to 2015, we had a 5-year run where, pretty much every stock benefited. Stock market doubled from its collapse in 2008, 2009. So I am expecting a correction in the 10 to 20% range. I'm not expecting a crash or a repeat of what happened 6 years ago, but I do think once the Fed does raise rates, that'll be the trigger that'll probably, for the correction. We're also heading into a presidential election year. In fact, coincidentally, tonight is the first Republican debate, and I think that's going to trigger some anxiety in investors. So, again, with China stock market contracting, people still a little nervous over Greece and what's going on in Europe, and the Fed about to raise rates, I wouldn't be at all surprised to see about a 15% correction over the next 12 months. However, after that, I expect the next 5 years or so to be kind of more of a typical stock market where we see equity and returns in the high single digits, maybe 8 to 10% on average, starting from 2016 through 2020. But I wouldn't be surprised to see a bump in the road here in the next 12 months before that gets going.
Great information from Jim Pearce, Chief Investment Officer of Baton Investing, joining us here on Benzinga's Pre-Market Prep. Jim, thanks a lot. We'll hope to talk to you again soon.
Thanks for having me. Appreciate it.